Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SKYWEST Inc. Annual Report. SKYWEST Inc. offers a diverse range of businesses and services through its subsidiaries. At the core of its operations is the regional airline business, which provides scheduled air transportation to various destinations across the United States, Canada, and Mexico. The company operates through two main segments, SKYWEST Airlines and SWC. In addition to its airline operations, SKYWEST also engages in aircraft leasing, providing regional jet aircraft and spare engines to third-party airlines. This service allows other carriers to expand their fleets without having to purchase new aircraft outright. Furthermore, the company offers on-demand charter services, catering to customers who require customized air travel arrangements. SKYWEST services extend beyond just airline operations. The company also provides airport customer service and ground handling services for other airlines, ensuring a seamless experience for passengers and cargo alike. With a fleet of 637 aircraft and approximately 2260 daily departures, SKYWEST is a significant player in the regional air transportation market. Overall, SKYWEST's business model encompasses a range of services that cater to various needs within the airline industry. From scheduled air transportation to aircraft leasing and charter services, the company has established itself as a key provider of regional air travel solutions. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what may cause a stock price to remain stagnant over a period of time. The stability of a company's stock price is often influenced by various factors that can either positively or negatively impact its value. One reason for a lack of significant change in a stock price is the absence of any major news or announcements from the company itself. This could be due to the fact that the company has not released any new products, services, or initiatives that would excite investors and drive up demand. Another possible explanation is that the industry as a whole is experiencing a period of stagnation. If the airline industry, in this case, is facing challenges such as increased competition, rising fuel costs, or regulatory hurdles, it may not be able to grow its revenue and profits, leading to a stable but unremarkable stock price. Additionally, external factors such as economic conditions, interest rates, and market trends can also contribute to a stagnant stock price. If the overall economy is experiencing a slowdown, investors may become more risk-averse and less likely to invest in stocks that are not performing exceptionally well. Lastly, it's possible that SKYWEST Inc.'s stock price has simply reached a plateau due to its current valuation being reasonable and reflective of the company's fundamentals. In this case, there may be no compelling reason for investors to buy or sell the stock, leading to a stable but unremarkable price movement over time. In conclusion, a stagnant stock price can be caused by a combination of internal and external factors that affect a company's performance and industry trends. Without access to specific information about SKYWEST Inc., it is difficult to pinpoint the exact reason for its stock price stability. SKYWEST Inc. market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $13 billion. SKYWEST Inc. trades at a higher price-to-earnings ratio of 10 times and a lower price-to-book ratio of 1.53 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of various factors. On the positive side, a significant increase in block hours and number of passengers carried on pro-rate routes contributed to revenue growth. The addition of new aircraft, such as EON 175 and CRJ 550, also boosted revenues. Furthermore, increases in operating revenues, flying agreements revenue, and lease, airport services, and other revenue all contributed to the overall growth. On the other hand, a decrease in the number of aircraft in scheduled service or under contract led to a decline in revenue. Additionally, inflationary pressures and labor costs had a significant impact on operating expenses. Other factors that affected revenues include fuel price fluctuations, interest rates, changes in codeshare agreements with major airline partners, flight schedule changes, and contract modifications resulting from renegotiations. In summary, the primary drivers of revenue growth were increases in block hours, number of passengers carried, new aircraft additions, and increased operating revenues. Conversely, decreases in aircraft numbers, inflationary pressures, and labor costs led to a decline in revenue. The net income of the company underwent significant changes between 2023 and 2025. Initially, it decreased from 2023 to 2024, but then increased by $105.3 million in 2025, representing a 32.6% growth over the previous year. This increase was largely driven by higher revenue and lower interest expenses. However, profit margins experienced mixed trends during this period. On one hand, they decreased from 84.3% to 75.6% due to increased costs such as security, fuel, and labor expenses. On the other hand, they also increased from 7.8% to 10.6%, indicating a more stable financial performance. The reasons behind these changes are multifaceted. Decreased passenger traffic and yields, along with increased security, fuel, and other costs, contributed to the decline in profit margins. Additionally, higher labor costs, which accounted for 45.3% of total operating expenses in 2025, further eroded profitability. The inability to offset these increased costs through rate hikes also played a significant role. Despite these challenges, the company's net income and profit margins showed signs of improvement in 2025. This was largely due to higher revenue and lower interest expenses. However, the increase in receivables from December 31, 2024 to December 31, 2025, and the higher credit risk associated with certain outstanding receivables remain concerns that need to be addressed. The company's financial performance indicates a significant improvement in its ability to generate operating cash flow. The data shows that the net cash provided by operating activities has increased from $692,462 in 2024 to $940,364 in 2025, representing a substantial growth of 35.8%. This upward trend is consistent across all 3 years, with positive operating cash flow generated in 2023, $736,334, 2024, $692,462, and 2025, $940,364. These numbers confirm that the company has successfully transitioned to generating positive operating cash flow, a crucial indicator of financial health. The company's debt level has undergone significant changes over the past year. According to various reports, outstanding debt decreased by $0.3 billion, 11.1%, from 2024 to 2025. This reduction in long-term debt is evident across multiple pages, with a decrease of $291,514, 13.8%, and a carrying value of $2,408,369 as of December 31, 2025. In terms of interest expenses, the company has also experienced a notable decline. Interest expense decreased by $9,895 from 2024 to 2025, representing an 8.1% decrease in interest expense over the same period. This reduction in interest expenses is likely due to the decrease in debt level and may indicate a more favorable financial position for the company. Overall, both debt levels and interest expenses have changed significantly, with a notable decrease in long-term debt and interest expenses. These changes suggest that the company has made efforts to manage its debt and reduce its financial obligations, which could have positive implications for its future performance. Management is optimistic about the company's outlook, expecting continued demand for its product and fleet expansion. They anticipate improving financial and operating results in the future, driven by increased utilization and efficiency of their fleet. The company is also investing in developing the next generation of aviation professionals through partnerships with flight schools and educational institutions. To address pilot attrition trends, management is providing career pathways for pilots and maintenance technicians through programs such as the SKYWEST Pilot Pathway Program and the AMT Pathway Program. They are also focusing on retaining professionals through ongoing training and development opportunities, including leadership development courses. In terms of strategy, the company is committed to working with major airline partners to lower their environmental footprint while continuing to offer best service to customers. They are evaluating opportunities for sustainable aviation fuel and electric ground equipment, and have entered into a strategic arrangement with Eve Holding to develop eVTOL aircraft deployment network. However, management also acknowledges the challenges facing the company, including intense competition from major airlines and low-cost carriers. They recognize that labor costs may not remain competitive in the future and are focusing on implementing succession plans for key staff and sustaining employee engagement in the company's strategic vision. The company's financial situation is also a concern, with significant long-term debt obligations that could limit their ability to obtain additional financing for expansion plans. Management is anticipating closing on remaining financings under a master equipment purchase agreement during 2026, but may need to seek additional financial liquidity in the short term, which may not be available on favorable terms. The company has a history of not paying dividends to its shareholders. This is evident from the absence of any mention of dividend payments in the provided summary. On the other hand, the company has been actively involved in share buybacks. According to the information, the company has purchased a total of 5,675,819 shares. Additionally, it has the capacity to purchase up to $460,694 worth of shares. Furthermore, the data shows that the company bought back a significant number of shares in 2023, with a total of 10.6 million shares being repurchased. That concludes the financial summary for SKYWEST Inc. Feel free to comment below, and I will be happy to answer them when possible.